When the markets open, the world expects order. Screens light up, numbers flow, and confidence rests on one assumption: the system is working. But today's message challenges that assumption. It was a hack. And when something powerful like CME reporting goes dark, the real question is not whether markets will react, but how prepared we are when they do. Because moments like this don't just move prices, they expose truth. Markets are built on information, not emotion. Every trade, every price, every decision depends on continuous, trusted data. When that data disappears, even briefly, the market doesn't pause. It keeps moving, but without clear direction. That's when uncertainty replaces logic, and volatility replaces stability. And here's the hook most people miss. The danger is not the silence itself, it's what rushes in to fill it. When reporting systems go dark, confidence fractures. Liquidity pulls back. Algorithms hesitate, then overreact. Orders stack up unseen. Risk accumulates quietly in the background. And when markets finally open with visibility restored, the release is sudden and violent. Prices don't ease into reality, they jump to it. This is why something crazy happens. Not because the market is broken, but because it is catching up all at once. Now let me be direct. These moments separate participants from professionals. The unprepared react to headlines. The disciplined respond to structure. In a world where markets operate at the speed of light, infrastructure is power. Those who understand how outages distort price discovery don't panic, they anticipate. They know that transparency smooths volatility over time, and when transparency disappears, volatility concentrates. This is not about fear. This is about awareness. The market is not a moral system, it is a mechanical one. When information flow is interrupted, outcomes become asymmetric. Some gain speed, others lose clarity. That's not unfairness, that's reality. And the lesson here is simple but uncomfortable. The market rewards those who respect risk more than those who chase certainty. So what do you do when markets open after a disruption like this? You slow down when others rush. You observe when others react. You let price show intent before you commit capital. Because the biggest mistakes are not made during chaos, they are made immediately after, when people assume the danger has passed. Markets don't fail because of hacks or outages. They reveal their true nature through them. They remind us that discipline beats prediction, preparation beats panic, and clarity beats speed. And as the screens turn back on and trading resumes, remember this: the real edge in economics is not knowing what will happen next. It's knowing how to stand steady when everyone else is moving fast. Market functionality in modern economics is inseparable from the continuous flow of information. Prices are not random numbers on a screen. They are signals formed through the constant interaction of data, expectations, and capital. Every bid and offer reflects a shared understanding of value at a specific moment in time. When reporting systems operate smoothly, this understanding updates in real time, allowing markets to coordinate behavior efficiently. The moment that flow is interrupted, even briefly, the coordination mechanism weakens, and price loses its role as a reliable messenger. What many underestimate is how quickly uncertainty replaces information. When critical reporting goes dark, the market does not stop trading, it starts guessing. Participants are forced to operate with partial visibility, relying on outdated signals or assumptions rather than verified data. This shift is subtle at first, but its impact is immediate. Spreads widen, execution slows, and confidence erodes. The hook here is simple, but powerful markets do not need bad news to move violently. Missing information is enough. Efficient price discovery depends on synchronization. Buyers and sellers must see the same data at roughly the same time for prices to adjust smoothly. When that synchronization breaks, prices stop evolving gradually and begin jumping in discrete steps. These jumps are not irrational, they are delayed reactions. Orders that would normally be absorbed over minutes or hours accumulate unseen, creating latent pressure. When visibility returns, the market is forced to absorb all of that pressure at once, often in seconds. Another critical dimension is behavior. Economic theory often emphasizes rational decision-making, but real-world markets operate at the intersection of logic and psychology. A lack of transparency amplifies fear, not because participants expect collapse, but because they cannot measure risk accurately. Inability to observe volume, positioning, or settlement data creates hesitation. That hesitation is contagious. Liquidity providers pull back not to speculate, but to protect themselves from unknown exposure. In doing so, they unintentionally intensify the very instability they seek to avoid. This is where the structure of modern markets becomes impossible to ignore. High-frequency systems, automated strategies, and global connectivity mean that even small data interruptions propagate rapidly. A temporary reporting failure can influence pricing across asset classes, time zones, and correlated instruments. The market reacts not to the outage itself, but to the uncertainty it introduces into interconnected systems. The hook here is uncomfortable, but necessary. Complexity increases efficiency in normal conditions, but it magnifies fragility when transparency fails. The most important insight is that continuous information flow does not eliminate volatility, it manages it. Transparency allows risk to be priced incrementally, distributing adjustment over time. When that flow is disrupted, volatility compresses and waits. Once information resumes, the market releases that compressed adjustment in a single, forceful move. Understanding this dynamic transforms how one views disruptions. They are not anomalies, but stress points that reveal the true dependence of market stability on information continuity. For disciplined participants, this awareness changes behavior. Instead of reacting emotionally to sudden moves, they recognize them as mechanical consequences of delayed price discovery. They understand that when information goes dark, the market is not broken, it is blind. And when sight returns, the reaction is swift, decisive, and often unforgiving to those who mistake speed for clarity. Volatility is often misunderstood as a sudden or emotional reaction, but in economic terms, it is more accurately described as the visible release of accumulated risk. When reporting systems or market data streams are disrupted, that risk does not disappear. It is deferred. Information disruptions act like a compression mechanism, quietly storing pressure beneath the surface of the market. The moment transparency returns, that pressure is released, and the result is sharp, often surprising price movement. This is why volatility appears to explode. At market open, after an outage, it was never created in that moment, it was waiting. In normal conditions, markets adjust continuously. New information is absorbed incrementally, spreads fluctuate modestly, and liquidity allows prices to move in controlled steps. When reporting goes dark, this process breaks down. Participants cannot properly recalibrate risk because the signals they rely on are incomplete or delayed. Trades still occur, positions still exist, but adjustments are postponed. The hook here is critical. The market is not calmer during an information blackout, it is merely silent. This silence creates a false sense of stability. Without visible data updates, price movement may appear restrained, but underlying risk continues to grow. Orders queue up, hedging is delayed, and exposure becomes increasingly misaligned with real conditions. By the time reporting resumes, the market is no longer responding to one piece of information, but to many pieces at once. What would have been a series of small adjustments becomes a single, abrupt repricing event. Liquidity behavior plays a central role in this process. Market makers and institutional participants are highly sensitive to uncertainty. When data reliability is compromised, they reduce exposure, widen spreads, or temporarily step back. This withdrawal is rational, but it has systemic consequences. With less liquidity available, even modest order flow can produce exaggerated price movements. When trading normalizes, the sudden return of volume collides with thin depth, accelerating volatility further. The hook is uncomfortable, but real volatility spikes not because too many people trade, but because too few are willing to. Another factor is synchronization failure. Modern markets rely on precise timing and alignment across platforms. Reporting outages disrupt this alignment, causing different participants to react at different moments. Some respond immediately when systems come back online, others lag, and some act preemptively. This staggered response compresses activity into narrow time windows, increasing the likelihood of price gaps and rapid directional moves. The market does not transition smoothly from uncertainty to clarity, it jumps. Psychology intensifies the mechanical effect. When volatility finally emerges, it often exceeds expectations, triggering defensive reactions. Stop-loss orders activate, risk models adjust abruptly, and algorithmic strategies amplify momentum. What began as deferred adjustment evolves into a self-reinforcing cycle. Importantly, this does not require new fundamental information. The volatility is driven by timing, structure, and delayed risk expression rather than economic deterioration. The deeper insight is that information disruptions reshape the distribution of volatility, not its magnitude. Risk that would normally be spread across hours or days is concentrated into minutes. Understanding this allows market participants to interpret sudden moves more accurately. They are not anomalies or signs of systemic collapse, but predictable outcomes of interrupted information flow. In economics, recognizing how volatility is stored and released is not optional. It is essential for navigating markets when clarity returns all at once. Information asymmetry is one of the most powerful and least visible forces in economics, and it expands rapidly when market reporting systems fail. Under normal conditions, public data acts as a leveling mechanism, allowing participants of different sizes and strategies to observe roughly the same signals at the same time. Prices may still favor experience and capital, but transparency limits extreme imbalance. When reporting goes dark, that limitation disappears. The market does not become unfair in that moment. It becomes uneven, and uneven markets behave very differently. The critical hook to understand is this: when information is missing, advantage does not go to the smartest, it goes to the most prepared. Large institutions often operate with redundant data feeds, internal analytics, and pre-positioned risk frameworks. Even when public reporting is interrupted, these participants are not blind. They still observe partial signals, correlated markets, and internal flow. Smaller participants, by contrast, lose their primary reference points. The result is not just delayed reaction, but reduced confidence, which directly affects decision quality. This widening gap alters behavior across the market. Those with superior visibility continue to act, adjusting exposure gradually or positioning for reopening dynamics. Those without it hesitate, reduce size, or exit altogether. Liquidity becomes increasingly concentrated in fewer hands. Prices still move, but they reflect the actions of a narrower group of participants. That concentration makes markets more sensitive and less resilient. A single large order can now have outsized impact, not because demand has changed, but because participation has thinned. Execution quality also deteriorates under information asymmetry. Without reliable benchmarks, participants face higher slippage and wider spreads. They may accept worse prices simply to reduce uncertainty. This creates a feedback loop. As execution costs rise, participation declines further, reinforcing the dominance of those least affected by the data disruption. The hook here is uncomfortable, but accurate markets do not pause for equality. They reward continuity. There is also a temporal dimension to this imbalance. When reporting resumes, those who maintain situational awareness act immediately, while others are still processing what changed. This timing advantage is often measured in seconds, but in modern markets, seconds are decisive. Early movers capture favorable pricing, while late responders absorb the adjustment. What appears as sudden market aggression is often nothing more than faster recognition of restored information. Importantly, this dynamic is structural, not malicious. It is a function of how markets are built. Systems are designed to reward speed, redundancy, and preparation. Information disruptions simply expose this design more clearly. For those who rely solely on public feeds, outages feel like chaos. For those with layered access and predefined strategies, they feel like stress tests. The economic lesson is not to assign blame, but to understand incentives. Information asymmetry during reporting failures shifts risk and opportunity unevenly across participants. Recognizing this allows individuals to adjust behavior, reduce overconfidence, and respect moments when the informational playing field is tilted. In markets, awareness of asymmetry is not cynicism, it is realism, and realism is what keeps capital intact when visibility disappears. Liquidity is often treated as a background condition in markets, something assumed to be present until it suddenly isn't. In reality, liquidity is a choice made continuously by market participants, especially during periods of uncertainty. When reporting systems go dark and transparency weakens, that choice changes almost immediately. Market makers and large participants do not withdraw because they expect collapse. They withdraw because they cannot accurately price risk. The hook is simple and powerful. Uncertainty does not remove liquidity slowly. It makes it step aside all at once. Under normal conditions, liquidity acts as a shock absorber. It allows prices to move incrementally, smoothing the adjustment to new information. When transparency is disrupted, that absorber stiffens. Spreads widen, order book depth thins, and the market becomes more sensitive to individual trades. This shift often goes unnoticed at first, creating the illusion that markets are stable. But stability without depth is fragile. It takes very little order flow to disturb it. The decision by liquidity providers to pull back is rational. Without reliable reporting, they face asymmetric risk. They can be adversely selected by better, informed traders or exposed to sudden repricing when data returns. To protect themselves, they reduce exposure, increase margins, or temporarily exit. Each of these actions reduces available liquidity. The hook here is critical. Liquidity disappears not because fear dominates the market, but because information no longer anchors price. As liquidity withdraws, the market's ability to absorb risk weakens. Trades that would normally have minimal impact begin to move prices disproportionately. This creates a feedback loop. Observing wider spreads and erratic price behavior, additional participants reduce activity, further thinning the market. By the time reporting resumes, the order book is shallow, and prices are highly sensitive to incoming orders. When transparency returns, repricing is inevitable. The market must incorporate delayed information, recalibrate risk, and attract liquidity back into the system. But this process is not smooth. Liquidity does not return all at once. It re-enters cautiously. Early trades face limited depth, causing sharp price movements. These movements signal opportunity to some and risk to others, drawing in more participants and accelerating the adjustment. What looks like chaos is actually the market rebuilding its depth in real time. This repricing is often misinterpreted as overreaction. In reality, it reflects both informational catch-up and liquidity restoration occurring simultaneously. Prices overshoot not because markets are irrational, but because depth lags behind demand. The hook here is subtle, but essential. Prices move violently when liquidity is scarce, not when opinions are extreme. Understanding this dynamic reframes how one views market disruptions. Liquidity withdrawal is not an anomaly. It is a protective response embedded in market structure. Reporting outages simply expose how quickly liquidity conditions can change and how central transparency is to market stability. For disciplined participants, recognizing the link between information, liquidity, and repricing allows for better timing, improved risk management, and restraint when sudden moves tempt impulsive action. Systemic disruptions such as reporting outages are often described as failures, but from an economic perspective, they function more accurately as stress tests. They place market structure under pressure and reveal how it behaves when normal assumptions no longer hold. When systems operate smoothly, inefficiencies remain hidden, masked by liquidity, speed, and constant data flow. When those systems are interrupted, the underlying mechanics are exposed in real time. The hook to recognize here is that markets do not reveal their true nature during calm periods, they reveal it under strain. These events demonstrate that modern markets are deeply dependent on infrastructure. Trading is no longer just an interaction between buyers and sellers, it is an interaction between technology, timing, and trust. When reporting goes dark, confidence in that infrastructure weakens and behavior shifts accordingly. Participants reassess risk, not because economic fundamentals have changed, but because the reliability of the system delivering information has been compromised. This reassessment is rational, and it ripples through pricing, liquidity, and participation. One of the most important revelations during disruptions is how quickly discipline becomes more valuable than prediction. Without clear data, speculative behavior becomes costly, while risk-managed strategies gain relevance. Participants who rely on predefined limits, scenario planning, and structural awareness tend to remain functional. Those who depend on constant signals struggle. The hook here is practical, and sharp stress does not reward insight. It rewards preparation. Disruptions also clarify the role of redundancy. Markets favor participants with multiple data sources, diversified execution paths, and flexible risk frameworks. When a single reporting channel fails, those with layered systems adapt, while others are forced to pause. This difference is not about privilege alone. It reflects investment in resilience. Stress events expose the cost of operating without backup, turning theoretical risk into immediate constraint. Another critical insight is that market stability is behavioral as much as technical. Infrastructure failures alter incentives, prompting collective shifts in behavior that amplify mechanical effects. Liquidity providers protect capital, traders delay decisions, and algorithms adjust thresholds. None of these actions are irrational in isolation, but together they reshape market dynamics. Stress tests show how individual risk management choices aggregate into systemic outcomes. Perhaps the most valuable lesson from these events is perspective. Reporting outages and similar disruptions remind participants that markets are not designed to eliminate risk, only to price it. When pricing mechanisms are impaired, risk becomes harder to measure, not larger in absolute terms. Recognizing this distinction prevents overreaction and encourages analytical thinking when volatility appears excessive. For serious market participants, stress events redefine priorities. They shift focus away from short-term narratives towards structural understanding. They highlight the importance of patience when visibility is limited and decisiveness when clarity returns. Most importantly, they reinforce that success in markets is less about avoiding disruption and more about understanding how systems behave when disruption occurs. In economics, that understanding is not optional. It is the difference between reacting to events and navigating them.